$650 billion. 6 hours. Read that again. Not a quarter, not a fiscal year. 6 hours. That is how long it took for $650 billion to be added to the global precious metals market cap as a single geopolitical headline crossed the wire. If that number did not physically interrupt whatever you were doing, you are not paying close enough attention to what is unfolding in these markets right now, because the number is extraordinary. But the mechanism behind it is what actually matters. What follows is not a trade tip, not a hot take, not a thumbnail headline engineered for clicks. It is a structured, data-first breakdown of why silver closing at 94.3 on Western futures, gold printing its 7th consecutive monthly record close, and CME open interest collapsing 27% in a single month are not isolated events. They are converging signals, and they are pointing toward the same conclusion. A paper market under structural stress that the mainstream financial press has not even begun to address. Every number referenced here is publicly verifiable. COMEX vault reports, Shanghai premium data, CME commitments of traders, lease rate history. None of it is rounded for effect. None of it is sourced from rumor. You can confirm every line item yourself. That is the standard. Now back to the $650 billion. The dollar figure is not the critical element. The mechanism is. Oil moved, gold moved, silver moved, simultaneously, energy, monetary hedge, industrial metal, 3 different supply chains, 3 different demand profiles, 3 different buyer bases, moving in lockstep. That does not happen randomly. It happens when capital is pricing a shared risk vector. On this occasion, the signals were geopolitical, Washington statements, Tehran tensions, China advising citizens to exit, 3 governments, 1 6-hour repricing across the hard asset complex. That is tail risk being priced in real time. But the geopolitical backdrop is context. The primary story is structural, specifically the divergence between paper silver pricing and physical silver pricing. Right now, those two markets are separated by $12 per ounce and widening. Western futures closed at 94.3. Shanghai spot is pricing materially higher, a $12 premium for the same metal. That is not noise. That is not arbitrage friction. That is physical buyers paying above paper benchmark pricing for certainty of delivery. Certainty of delivery. When price rises and the premium widens simultaneously, it means higher prices are not unlocking sufficient new supply. That dynamic has a name, structural shortage. And structural shortages do not resolve with moderate price appreciation. They resolve when price moves far enough to either destroy demand or force meaningful production response. Neither outcome happens at 94. Now layer in the streak. Silver has closed green for 10 consecutive months. 10. That is not retail enthusiasm. Retail does not sustain 10-month streaks. Retail reacts to streaks. Sustained monthly performance of that duration requires patient capital. Institutional reallocation. A macro thesis being executed irrespective of short-term volatility. Gold is running a parallel confirmation. 7 consecutive monthly record closes. These are not speculative flukes. Price is the last thing to move. The structural forces, supply deficits, sovereign accumulation, geopolitical fragmentation, build quietly. Then price confirms them. Now look at lease rates. Silver lease rates recently printed 1.6%. Context matters. In prior years, the average sat near 0. A move to 1.6% is not incremental. It is a regime shift in borrowing cost for physical metal. Lease rates spike when sourcing metal becomes more difficult, when delivery certainty becomes more valuable. Now look at CME open interest, down 27% in 30 days, while price rose from the 80s to 94. In a textbook bull market, rising prices attract new contracts. Open interest expands. Here it contracted by roughly 44,000 contracts. That is not small-scale profit-taking. That is institutional repositioning. The conventional explanation would be aggressive short covering, but forced short covering of that scale typically produces vertical price acceleration. Silver moved higher, yes, but not explosively higher. So what explains the contraction? Commercial hedgers migrating away from exchange-based futures exposure. Margin adjustments, liquidity degradation, execution mechanics increasingly dominated by high-frequency arbitrage strategies. If hedgers cannot efficiently manage real physical inventory risk on the exchange, they move to OTC channels. And when hedgers exit, downstream effects cascade. Dealers face more balance sheet exposure. Bid-ask spreads widen. Buyback prices compress. Payment timelines extend because of risk management under stress. Now the COMEX vault data. Registered silver increased modestly. Eligible silver declined. Net total inventory slightly lower. When eligible declines while registered rises, it often reflects reclassification of existing metal to meet delivery requirements, not fresh supply entering the system. Metal was already there. It was simply converted to delivery-ready status, In a market experiencing elevated lease rates and widening physical premiums, that nuance matters. Now the bearish case. Silver at 94. After 10 consecutive green months is technically extended. Corrections follow extended streaks. Shanghai premiums have normalized in past cycles. Lease rates, while elevated, are below historical squeeze extremes. Geopolitical spikes can retrace. Those are valid considerations. Thesis and short-term volatility are separate conversations. A 5 to 10% correction would not invalidate a structural bull framework. It would test conviction. The larger pattern remains. Multi-year supply deficits unresolved. Central bank gold accumulation elevated for consecutive years. Geopolitical fragmentation across multiple theaters. Commercial hedging infrastructure shifting away from exchange. Physical markets pricing scarcity more aggressively than paper benchmarks. This is the configuration of a multi-year swing. The first leg of such moves belongs to the informed minority. The second leg begins when mainstream validation arrives. By then, entry efficiency is gone. John O.G.